Hi everyone, ever since COVID-19 happened, it seems that the global economies of the world have been changed permanently. Prices have risen everywhere. The governments were frantically releasing stimulus packages to help the citizens while fighting COVID on the same front. And the central banks of the world, they always seem to be playing the catch-up game with inflation. In my last video, I touched on the cost of living in Penang. I briefly covered inflation and how it impacts your cost of living. Do take a look, I'll share the link below. In today's video, I will start by explaining how inflation rates have been impacting the global economy since 2020, how it is related to the US Federal Reserve aggressive rate hikes in 2022, and how wages have been stagnating for the past few decades. I will also cover the Great Resignation followed by the Great Termination, and ultimately how that impacts you and your way of living. Hi everyone, I'm John from the Corporate Breakout Couple. Together with my wife Fran, we retired young in 2020 at the age of 40 in Singapore. It would be fantastic if you would hit the like button and subscribe to our YouTube channel, as you will help with the YouTube algorithm to create more videos like this for you. According to Investopedia, inflation is defined as a sustained increase in the general level of prices for goods and services. In other words, it means too much money chasing too few goods. You can see from the chart for the inflation data for US in the last 10 years, for 2021 and 2022, it has been abnormally high with 7% and 6.5% respectively. So what has caused inflation to shoot up in the last 2 years? Broadly speaking, it is a mixture of money printing by the central banks, which released a lot of liquidity into the markets, the commodity prices increase, such as oil caused by the Russian-Ukraine war, and the supply issues by backed up supply chain due to the pandemic. In 2020, when the pandemic hit, there were many unknown factors created. The governments of the world came in with rescue packages, such as the US stimulus and relief packages, and the Federal Reserve suddenly reduced the interest rates to zero. Borrowing became easy as there were a lot of liquidity in the markets and companies borrowed extensively at extremely low interest rates. The stock markets rebounded almost immediately in a matter of months, accelerated by stay-at-home high-growth stocks. Basically, the stock markets embarked on a super bullish run because of price-in optimism that is caused by easy money with a lot of euphoria. Now in 2021, when the borders started to open, the companies that were badly hit by the pandemic, such as travel and hospitality, started their recovery. As such, the financial markets continued its outward movement as borrowing was easy, and that was when inflation started creeping up as well. Key markets such as real estate pushes inflation up even more. Think of it this way, because of the pandemic, the cost of construction such as labor and cost of materials gone up. That means property prices go up as well. Now, for every healthy economy, there must be a nominal inflation for your economy to grow. However, too much of it is no good, as that will cause the prices of consumer goods to shoot up dramatically. Therefore, for the healthy growth of the US economy, the Federal Reserve attempts to keep the inflation rate at 2% or lower. 2022, full inflation hits due to an abnormal pandemic period, and the Federal Reserve started to increase interest rates aggressively. The Feds were increasing interest rates every other month, as much as 50 basis points or 75 basis points, which is 0.5 and 0.75% each time. And how does that affect you? Let me give you an example. If you're holding a mortgage loan in Singapore, say you are taking a 2% floating rate, when the Federal Reserve increased their interest rates by 100 to 150 basis points in a matter of months, that brings your 2% to 3% almost in a matter of months. And you know, property prices in Singapore, well, is not exactly cheap. So people could be holding a $500,000 to $1 million loan on their houses. And what does that mean? If you do the math, the 1% increase in your mortgage loan, well, let's just say that that won't sit well with your bank account. So, by the end of 2022, the Federal Reserve has increased the interest rates to 4.25%. Well, they are not stopping at all. They are slowing down, and their target is 5.1%. And the financial markets had started to normalize, and the economies of the world have started to slow down. So now, in 2023, because of the much higher interest rates, borrowing became more expensive as there's less liquidity in the markets and hence inflation has been slowing down. The reason why I'm explaining to you the timeline of events and why the Feds are making such moves is so that if you can understand the intention and the come from behind the Federal Reserve, you can better position your finances, your investments, such that your asset allocation and your portfolio will be in a better shape than before. Being attuned to the global markets and knowing your own country's economy well will give you an advantage to stay ahead of the curve, such that you can make better informed decisions about your investments and about your career as well. Based on this CNBC article, a record of 4.5 million workers walked away from their jobs in March 2021 alone. The initial surge was due to the backlog of resignations since workers weren't quitting due to the height of the pandemic. They were also burned out, unhappy and re-evaluating their lives. There was a labor crunch in 2021 and the demand for employment from companies outweighs supply. And that means employees have options to pick and choose. Now let's take a look at wages in the last few decades. From this article, wages in the US have stagnated since the early 1970s. Between 1979 and 2020, workers' wages grew by 17.5% while productivity grew over 3 times as fast as 61.8%. So, if the inflation rate had been increasing fast for 2021 and 2022, but yet the rate of increase for wages had not kept up, where does that leave us? And don't forget, most people who hold employment only have one source of income, which is their job. So does that mean they are losing money to inflation every year? How fast times have moved from the Great Resignation in 2021 to the Great Termination in end 2022. This is a very recent article that talks about the Great Resignation to the Great Termination, where there's massive layoffs for a lot of companies such as tech giants like Amazon and Google. And while doing my research, I was very intrigued to find a website that actually tracks all the layoffs by all the companies in a very detailed data format. Besides a possible recession, the theme of the year for 2023 might just be the Great Termination. So, I have a question for you. Do you have job security and are you in control over that? With artificial intelligence and machine learning, the low-level jobs have slowly been replaced and this has been going on for a while. Now, with ChatGPT, the latest talk of the town in AI, some of the mid and even high-level jobs may even be replaced. Essentially, my point is there are a lot of external forces at work which is out of your hands. In today's uncertain times, no one can predict what's going to happen tomorrow. Like it or not, seems like inflation is here to stay for a while. Our wages doesn't seem to be able to keep up with the price increase in consumer goods. Neither does the bank interest rates. That means your savings in the banks are getting eroded by inflation as well. Here are some things you could do that are within your control. Number 1, build your foundation on money management and investing principles. After you have crafted out your financial plans, stand firm on your plans and be disciplined and consistent in your approach. Number 2, stay agile. Position your finances and your investments as well, such that you can move fast. The world is changing fast. It's important to be nimble with our decisions. That means you need to stay open-minded and be willing to learn fast. Invest in courses in your personal development to set yourself up to win. Number 3, in terms of money management, spend within your means and always pay yourself first. Pay yourself first is a money strategy which prioritizes your first chunk of money towards savings and investments first before you put the rest towards your expenses. Number 4, for investing, always be up to date with the financial markets and understand where the money is moving towards. And if you're new to investing, focus on one type of investment first and get good at it, be it stock market, be it forex, be it real estate. And I'd like to share one of my favorite investing principles, which is called earn the right to scale. What does that mean? It means you start small, you get good before you earn the right to play at the next level. If you fail to plan, you plan to fail. Do assess your income stream for the next 5 to 10 years and make great plans to increase them every year. Also, exercise due diligence in every step you undertake. Practice risk management and be aware of your risk versus the reward. Having said that, find courage to take action. Remember, some action is better than no action at all. In my personal experience, I failed multiple times, whether in business or in my investments. And these failures proved to be the best lessons as they provided me the humility to learn, the resilience, and the tenacity to strive forward. I wish you all the best in your future undertakings. Every cloud has a silver lining, and I hope you find your doors of opportunities and enjoy the process while you're making your journey. I hope you enjoyed my video. Do hit the like button and subscribe to our YouTube channel as it will help us to make more videos like this for you.